Good morning, everybody. It's Todd Hanley here with Cross Country Mortgage, your senior loan advisor. Wanted to give you a weekly economic and market update. Let's jump right into it. The stock market is getting fully ahead of itself again. Why? Well, check out this screenshot from the CME Fed Watch Tool site. So here's the July expectations. It's for a 54% chance that the Fed's going to decrease rates as early as July by 25 basis points from where we're at today. If you look at this also, you can see that no more than 30 days ago, there was a 44% chance that the Fed was actually going to increase rates and that they would be 75 basis points higher than what the current expectation is. That is a huge change. And why did that change? Well, because the Fed, number one, here's a quote from the Barron's article reviewing the last meeting. The Fed came out and they said that the issues were limited to a few banks and emphasized the broader financial system was sound and resilient. So listen to that, sound and resilient. We still have inflation. We still have a strong economy, according to the Fed. But the Fed did suggest, the central bank suggested an end to rate hikes is near by removing a line from its statement about ongoing increases. So the median forecast among members of the Federal Open Market Committee is still for one more increase this year. Well, the CME tool is not showing that. They're going completely against what the Fed is saying. Bottom line here is that this morning we had some decent news come out. First Citizens Bank is agreeing to buy SVB's debt and most of their loans. There is a backstop by the FDIC, but look what happened to the 10-year yield this morning. Now, it's up exponentially, but take a look at the chart here. I did a post on March 15th about what the yield on a 10-year treasury could do, and I said there's a good chance it could hit 3.26. Due to the spreads, the rates never got as low as I thought, but it hit that point. Now on Friday, it gapped down and it hit 3.28. Here's the chart of that. But it gapped down in the morning and it bounced right back up before rates were even updated. And then there was a quick little rate update as the 10-year shot up even more throughout the day. Bottom line here is you can see that the trend was broken, which is a good sign. And from this chart right here, you can see there's a lot of down trend lines, 1, 2, and 3, that should protect the yield from going higher. Now, nothing is obviously guaranteed, but there is a lot of evidence showing that with this banking crisis, there's going to be a pullback on lending, and when lending gets reduced, the economy slows because there's businesses and a lot of consumers that rely on borrowing money. So are we going into a credit crunch? Possibly. We'll find out, but that will definitely slow the economy. Also, too, with the stock market, the PE, which is the price to earnings ratio, is so high on the S&P that it makes no sense why anybody would want to buy stocks right now with a forecast for a recession and slowing economy coming up. But there's a lot more greedy traders and investors in the stock market than around the bond market. So that's just the fact of the matter there. What are we coming up with this week? So on Tuesday, we have the Case-Shiller Home Price Index and FHFA Index. One thing that a lot of people were focusing on is the National Association of Realtors released their existing home sales, and their year-over-year prices for national home values came in at a negative. So a lot of people were focusing on that, but focus on these numbers coming up tomorrow because those are the most accurate depictions of home values in the United States. Case-Shiller and FHFA. Also, too, there's going to be pending sales is coming out. Pending sales is a good gauge to see what happened with sales over the last couple of months. It's sort of a lagging indicator, but it will see how many homes went under contract. Also, too, on Thursday, we have the final report for GDP for fourth quarter of 2022. Look out for a 2.7% reading. And also, too, on Friday, we have the Fed's preferred inflation index. This is coming in stronger than what we want to see, and it's over double what the Fed wants to see on the inflation front. So remember, the Fed said that inflation is a priority, not the economy. So if inflation is not going down, I can assure you that the Fed is not going to reduce interest rates in July. So if you are looking to buy stocks right now, I would be very careful because don't fight the Fed. Thank you all so much for watching. If you have any questions, always feel free to reach out, and have an absolutely amazing week. Take care.